Off another earnings season, and our next guest sees names like Goldman Sachs and Citi separating themselves from the pack. We're navigating how to play the banking sector with the Yahoo Finance playbook, and joining me now is Ken Leon, Director of Equity Research at CFRA. Ken, always good to see you. So let's talk about the banks. Let's look at the XLF. We're down, of course, today, Ken, but that's a nice move off that April low. Heading into this earnings season, Ken, how would you broadly characterize valuations for this sector, for your coverage universe, Ken?
Well, it's great to be here. And that was the big question we had really in August is, can these banks, the global U.S. banks, can they really earn their valuation? We also got some feedback at investor conferences in September from many of the large banks, and the managements are fairly optimistic in terms of market conditions and outlook. So as we look to next week, Tuesday, with the banks beginning to report, JPMorgan, Goldman Sachs, and Citigroup, we think expectations are high from investors, but we still see the opportunity for both a revenue and an earnings beat from many of these banks. And we've been tracking that closely over the last 6+ quarters, and they've been delivering on the results.
I want to dig into some of those names with you, Ken, but another question I have for you, I'm just curious, what does the regulatory landscape look like right now, Ken? You know, what has changed under this Trump administration, and what do you see changing ahead?
Yeah, it's a great question. And you know, for any CEO under the limelight, you know, it's a delicate dance with the Trump administration. But what we have seen so far is policies that are at least fostering U.S. economic growth. We're also seeing a regulatory framework from the Federal Reserve that is likely to be more pragmatic and enable these banks to do two things. One, have more confidence to increase lending into the economy, and two, the ability with outsized capital reserves to return them to shareholders. So I think it's a pretty good picture, but again, what you're going to hear from the industry and these banks is really keep a low profile here.
How do trends in credit quality look, Ken? I'm just curious, given what we hear about the consumer.
Yeah, bank analysts are a very nervous lot, and if you go back as far as I have, which is well before even the financial crisis, you're always worried about any kind of black swan event in the capital markets, or of course something disastrous that's going to affect credit risk. CFRA, we look at all the banks every quarter. We look at a lot of different metrics, and overall we're still in the safe, normalized range in terms of loan loss provisions, loan reserves, allowance for loan losses, et cetera. So generally, and we're not even seeing anything episodic with an industry that could be distressed. So we're always watching, but I think this will be more to the back of the bus when we hear what managements have to say about their results.
You know what I always like about CFRA, Ken? You guys don't just do buys. You do strong buys on occasion when warranted. Goldman Sachs, you say, that's a strong buy. Why, Ken?
You know, it's very interesting. And again, my check on the banks like Goldman in August, and then where we are today. Today, there's 30+ analysts covering Goldman Sachs. It has the lowest ratio of buy recommendations versus JPMorgan, Morgan Stanley, Citi, et cetera. And perhaps that's because of price performance, but our investment view really since May and still today is the delta to drive higher fundamentals, higher results is the capital markets and investment banking. And Goldman on equity underwriting on a global basis was number one. We're also seeing durable recurring fee income for Goldman coming out of asset and wealth management. And we're well past that experiment of getting into retail consumer finance.
What about Citi, Ken? Correct me if I'm wrong, but I feel like last time we spoke, you were a fan of Citi, of Jane Fraser and her strategy.
Yeah, I still am, but it's not like we're vulture bargain hunters right now. It's no longer trading at 30% discount to net tangible book value, so trading just above par. The other banks are valued higher. I think from Citi, you're going to see confirmation of what they've done with the restructuring. Just a week ago, they announced a buyer for Banamex, which was their consumer bank in Mexico. So Citi's aligned up, much more transparent to their businesses, predictable corporate treasury services, trying to get more wallet share and wealth as well as investment banking. She's done a good job. The stock is still, the most attractive on valuation.
We've been talking about some buys, Ken. There is a hold here I see in your coverage universe, Bank of America. So you're lukewarm there. How come?
The stock has actually done well in the last few weeks from, let's say, 42 to 50. When we think about Bank of America, not only over the last 6 quarters, but the last 5 years, it's been a laggard on performance, even to peers such as JPMorgan Chase or even Citi. And, there's nothing wrong with Bank of America. Certainly it stacks up well to the regional banks. But overall, we just don't see that outsized performance. And again, when we look at Bank of America, there's a lot that has to work well here. It's not only just loan activity, but when rates become to come down, it could put some pressure on spreads and net interest income. That's about 60% of total revenue. So nothing wrong with it.
Ken, 2 more names I want to squeeze in here because I want your thoughts. Morgan Stanley and JPMorgan. What are you telling clients?
So Morgan Stanley, almost just like Goldman Sachs, but much more leaning into wealth management besides investment banking. They're going to be at the top of the stack with Goldman in terms of, I think, earnings and revenues beats. They're also looking to gain wallet share outside the U.S. JPMorgan Chase, back in the summer, we got off from a buy to a hold. We came back with a buy. And again, when you look across all the businesses and the executive talent that JPMorgan Chase has, we think it's a winner, and it's one of the top 3 constituent in the financial sector. So it better work well because we have an overweighting on the sector.
Ken, always appreciate your time and those stock picks. Thank you.
Thank you.
Big banks are set to report third quarter earnings in the coming days. Analysts expecting strong results boosted by a rebound in investment banking. Joining me now, Chris Whalen, Whalen Global Advisors chairman, longtime watcher of the financial industry. Good to see you, Chris.
I see you, Julie.
So what are the big themes you're going to be watching for? Trading profits, great. Rates going down, double-edged sword.
Right.
But what's going to be sort of the driving force this quarter?
I think like last year in the third quarter, when we had a little bit of a rate rally, we're hoping that rates are going to slowly fall enough to get volumes up. Because what's interesting is we've been talking about eventually the Fed cutting rates. The industry has been cutting rates for several quarters. They've been pushing rates down, partly because there's not much demand, partly because it's very competitive. There aren't a lot of big assets out there. So all the banks, the non-banks, the funds, everybody is competing for the same dollar of assets. The retail side, mortgage lending, they were all front running the rate cut by the Fed, a few weeks ago. So they pushed rates almost down to 6% for 30-year fixed rate mortgages. They backed up a little. But remember, lenders put coupons on loans, not markets. Markets are about when you sell a loan to an investor. So if the lenders want to get aggressive and get ahead of things, they can push coupons down. And you've seen that. A lot of banks have been very aggressive.
So in other words, like we're seeing really across the economy here, effectively cutting prices, or in this case, cutting
That's right.
rates to bring in those volumes. So maybe sacrificing a little margin to get those sales in the, to get that lending volumes in the door.
And get that customer and hopefully keep that customer. Whether it's a business customer or a consumer, doesn't matter. Because all of these big banks, whether you're talking about JPMorgan or Rocket Mortgage, they're little cities with moats around them. And they're trying to protect the portfolio of customers that they have, get some new ones if they can, but really it's about the network effect. No matter which industry you're looking at, Julie, it's about your network. Can you defend it? Can you grow it? So if you look at a JPMorgan, they're easily the price leader in the market because their costs are so low. The other banks have been forced to essentially accommodate that. How do you get growth in this industry? You go out and buy another bank.
Right.
So we saw Fifth Third buying Comerica, which is not a transaction I like, by the way.
Well, I want to get into that in a minute, but first, just to linger on the earnings for a second, we have seen a revival in IPOs over the last couple of months. Is that something that's going to show up yet in the earnings for the banks this quarter? Are we going to see that kind of IPO or M&A revival, show up in the IB numbers?
All of the above. Capital markets has done well. Look at Goldman. That's one of your weather vanes. Jefferies is another one you want to look at because they're in a slightly different calendar year. So you get a look at Jefferies before you get a look at everybody else. But the bottom line is the market side of the house is going to do well. It's going to make up for the lack of activity on the bank side of the house. And the other big issue for the banks, I think, is concentration risk. What has been growing in the past couple of years? Loans to funds, loans to non-bank financial companies. So that's the big worry you hear from people in Washington. So far, credit is okay. If anything, the banks have been giving back money instead of building reserves. And remember, we're going to buy back a lot of stock this year. Records, in fact.
Let's dig into the private credit thing for just a second here, because for people who are watching and don't understand quite how it works, basically you've had this ballooning of the private credit industry, non-bank companies lending out money to all kinds of different businesses.
Right.
But the banks lend those private credit company or invest in some of those private credit companies in turn. So they do have that exposure. There was just a company that went belly up that was an auto parts
First
company.
Brands.
That was very exposed in private credit, or private credit lenders were exposed there. Does that give us any kind of a taste of things to come, or do you think that is a rarity?
No, I think it is because the terms on these transactions have become so competitive that a lot of the protections that investors used to have aren't there anymore. So for example, there was no trustee for the debt of First Brands. There was no one watching their paper. They were double pledging the same accounts receivable paper to multiple investors. Remember Bear Stearns during the great financial crisis, multiple pledges of mortgages? This is the same thing. So I think the street is unfortunately paying the price for being so aggressive on the terms on these deals. Read the earnings call from Goldman Sachs, where they talk about taking losses on their own private equity portfolio, which is the same stuff they've been selling to their customers. So the street is conflicted in multiple ways here, and I think as we unwind it and we see the losses that some of the big universities and pensions and endowments are taking on private equity, that whole sector I think is going to cool off. But why were we doing this? Because there was no other activity out there. The banks went where the volumes were.
Right.
And again, we didn't have stuff to sell to the retail clients, the high net worth, the institutional. Yeah. So we created some new paper.
Well, hey, we've seen this movie before.
Yes, we have.
You and I know it very well from the financial crisis, but it doesn't feel as systemic or as alarming as it did back then.
Because it's private. Behind the veil.
Is it just because we don't know enough about it? Is it as alarming and we just don't know?
It's like commercial real estate. It's not a front page kind of story, so it's not going to grab people. What is going to grab people are things like the home builders, which have been selling off dramatically. Why? They have too much inventory, which they have been building by being very aggressive. They weren't discounting the houses. You know what they did? They were buying down the loans. So they would go to a consumer who couldn't afford a 7% mortgage, and they would subsidize 2 points of it and give them a 5%. Yep. So what's the probability of default on that subsidized mortgage? It's higher than somebody who could pay 7%.
All right, so a lot of things to watch going forward. And
well, credit is the story of the future. Let's put it that way.
Okay, so we'll keep talking about that, but I do want to get back to the consolidation story also. Fifth Third, Comerica. As you said, you were not a fan of that deal happening.
No.
Why not?
Fifth Third is a well-run regional bank based in Cincinnati, not known for aggressive M&A. I just don't know why they're doing this deal with Comerica. Comerica had moved from Detroit down to Texas years ago. They got badly beat up in 2023 when Silicon Valley Bank failed. So the bank has shrunk about 15% since then. They didn't cut their overhead. So the first thing that Fifth Third is going to have to do is take the chainsaw. They could borrow it from Elon Musk and go down to Dallas and really severely cut the costs on that part of the business. For me, all of the banks have the same problem. They feel like they have to get bigger. How do you get bigger? You go buy another bank. But many of these banks have done multiple acquisitions, so they end up with lots of goodwill, sometimes overhead that's not that attractive. There's a 12-point difference between Fifth Third and Comerica in terms of operating leverage. So they're going to have to fix that. I think, to me, you're going to see more deals like this, but they may not be that great because, again, if you look at the balance sheet, look at how much goodwill, look at the losses. One of the things that really struck me about Comerica is they're not doing a good job on their bond portfolio. The yield on their bond portfolio is in the twos.
Which is interesting because you would have thought if they got hit in 2023, they might have.
Well, yes and no, but you have to have the income. I'll give you two great examples. Truist, PNC, a couple quarters ago, they started restructuring some of their low coupon securities from the COVID years, and all of a sudden their net interest margin jumped. So the banks that have the income are being aggressive about fixing their balance sheet, but then you look at Bank of America, Brian is waiting for, the Fed to come to his rescue because he has a huge book, and his book is well below the peer group in terms of returns. So I think there's a lot of people are hoping that the Fed is going to pull up volumes, fix balance sheet problems, and maybe drive some M&A. But I don't know, banks are pretty well valued right now.
Gotcha. Just real quickly, who do you think is going to be the big bank winner of the earnings season?
Watch Citi. They're doing good things. They're still trading below book, but it's the best performer of the top five. Goldman is going to do very well, I think, looking at last quarter. The real issue is, are we going to get surprises?
Right.
Are we going to hear more losses on the private equity and commercial real estate side? Yes. But overall, I think the banks are still a snoozer. They're really not, on the consumer side at least, there's not a lot of pain. And the commercial pain, you don't see it. It's behind the screen. That's professionals and lawyers are dealing with that.
Interesting. Chris, good to see you. Thanks
Nice
for
to see
coming
you.
in. Appreciate it.